Today, we're going to do a video on a question I am asked a lot and see even more often in forums like Reddit. And that is, how do I value my startup, including startups that are pre-revenue? In this video, I'll walk you through the most common methods to establish a valuation of your startup, and that includes startups that have no revenue at all. Before we jump in, if you are a founder or executive of a startup and this type of content resonates with you, please hit the subscribe button. It really helps the channel and make sure you don't miss videos like this in the future. I put out a new video every single Friday. Okay, let's jump in. So, why do we want to value a company? Maybe you want to buy a company and want to do some due diligence and figure out what it's actually worth before putting in an offer. Maybe you want to sell your company, not really sure what price tag to put on it. Perhaps you just want to know the value of your company because you've been working on it for years and just want to make sure that your time has been worth it so far. Most likely, you're thinking about raising funds and you need to establish a value to start that conversation. So, where do you start? You look online, you can really go down the rabbit hole on this one. There's tons of different ways to do it. There's the Burkus method, the scorecard method, risk card summation method, the book value, standard earning multiple. There's tons of different ways that you can do this. But today I'm going to go over the top three that I see most often. And when we're done going through those three, I'll loop back and talk about how to value the company if you are pre-revenue. Okay, the first one, multiples or the market-based approach. As it sounds, it's really based off multiples. And multiples, simply put, is you're essentially taking a number to multiply the revenue to come up with a valuation of the company. So, for example, if you have $1 million in revenue and the multiple is 3x, the company is worth $3 million. Now, depending on the investor, they're going to look at the company in different ways, and they may take a different multiple based off a different type of revenue. It could be top line revenue, it could be bottom line revenue, or the most common that I see is EBITDA. By far, the most common method that I see is multiple based off EBITDA. If you are not familiar with EBITDA, EBITDA is earnings before interest, taxes, depreciation, and amortization. This approach is often used because EBITDA provides a measure of the company's operating performance before accounting for non-operating expenses such as capital structure, tax considerations, etc., making it a useful and, most importantly, a common metric for comparing companies, inclusive if you're comparing companies across different industries, etc. So multiples are based off comparables as well. And what I mean by that is they generally look at the market, more specifically your segment of the market, and they see what other companies are selling at and use their multiples. It's very similar to like if you were selling your home and wanted a value on your home, you can take comparables from homes that were similar to yours in your neighborhood and kind of come up with a range for what it's worth. You basically take the average or you find one that is very similar to yours, and you can use those multiples against your earnings, revenue, or EBITDA. The second method, DCF or discount cash flow. This is based off more of intrinsic value in the company or internal factors. When we talked about multiples earlier, that's based on external factors, similar transactions with other companies that are outside of your control. But the DCF or discount cash flow is about the value of your company today based on how much it will make in the future. So, for example, if you estimate how much you will make in the future, which is typically looking out between 3 and 5 years, you can develop a value that way. We generally don't look past 5 years because we don't even know if the company will exist in 5 years. But if we do, we'll include something else called the terminal value. That's a whole different rabbit hole we're not going to go down today, but we will do a video in the future on that. So for today's example, let's just assume we're going to take the revenue of the estimated revenue of the company over the next 3 to 5 years. That being said, it's not just as simple as adding up that future revenue because investors value today's money more than they value tomorrow's money or even next year's dollars. So There's a complex math equation to calculate this, but just assume that when doing this, we're going to come up with a financial plan that projects the revenue over the next 3 to 5 years. And we're going to take the revenue from each year, 1, 2, 3, 4, and 5. And as we go farther out, we're going to discount that a little more as we go. And then we're going to add up all the revenue and we're going to use that to determine the value of the organization. The third approach is the cost approach, and this is probably the simplest of all of them. We basically base the value of the company off its replacement cost. So more specifically, if you were to create the company all over again in the exact same way, what would it cost you to do so? So this is often used in industries that have a high amount of tangible assets, like property or products. You simply add up all the costs that it would take to replace. If you were to go out and just duplicate what you have, how much would it cost? So if you have $10 million in product in your warehouse, in property or assets, and that's what it would take to go out and purchase all over again to come up with an exact duplicate of your company would be worth $10 million. Okay, so what about a company that is pre-revenue or doesn't have any revenue right now? So firstly, we need to take a step back and remember at this point, the real purpose here is to determine the percent of the company an investor will own if you're going to take investment dollars, not necessarily the valuation of the company. So knowing that, you're also going to want to think ahead, knowing that this probably won't be the first time that you raise capital. And you're going to want to make sure that whatever you determine in respect to a percentage that you give up isn't too high, because you are going to get further diluted. So definitely keep that in mind. At this point, people are generally trying to raise between $1 and $3 million, and in exchange for about 15 to 25% of the company. So most people will try and back into those numbers. But of course, to do any of that, you need to value your startup, and also keep in mind you're going to be negotiated down. So it's a complicated dance here. That said, the mistake most people make at this point is to kind of add up their time, their investment dollars, maybe the little assets that they have, and put a number on it. And the reason that's not going to work is because at this stage of the business, it'll generally make the value of the company too low, which means you're not going to have enough investment dollars, or you're going to be giving away too much of your company. A better method to focus on is what we talked about earlier, is future revenue, and base a number off that potential revenue. So to do that, what you generally want to do is make sure that you have calculated the TAM, SAM, and SOM. The total addressable market is what we're going to focus on here. And you're also going to guesstimate what kind of market share you think is realistic for you to take over. I would suggest an average of 3 to 5%. And from that, you can build out a financial model, ideally 5 years out. So make sure it's no less than 3 years. I wouldn't do it more than 5 years. So I'd really shoot for a 5-year financial model based off the total addressable market, based off your market share of anywhere between 3 and 5%, and go from there. You're then going to want to do a comparison to make sure that you're in the right ballpark, and you're going to want to look at some comparable transactions. So you're going to want to convince your investor that you are similar to other pre-revenue startups that you are being sold or invested in, and as a result, use them as a precedent to establish your value. So as a side note, there's really only one way to increase the value of the company when raising funds at this point of your journey, and that's to get competing bids. So a strong suggestion that when you do go out to raise money, go out to the whole market and try and get a whole bunch of investors interested, even if you're not planning on taking their money. Use their competing bids to drive up the investment and, of course, what your organization is worth. Otherwise, you're going to need to simply let the market decide by offering a range of what you feel the company is worth, and let them basically offer what their investment is at your particular stage of your journey. So It will become a straight up negotiation, and the bottom line is your company's value is purely what someone is willing to pay for it. It's that simple. So, as a bonus tip, when raising funds, the real question that you want to ask yourself is not necessarily how much money can you get, but how much do you need in respect to finances to get to your first milestone? And that part and parcel to that question is also asking yourself, how much equity are you really comfortable in giving away? So, considerations in this number to hit your milestone: overall market potential, your role in the market, business model, team size, team cost, probably more importantly, how long of a runway will it give you? I.e., if you take that investment money, how long will it last to give you the opportunity to hit that first milestone? Second biggest mistake I see is valuing the company too high. And this causes a whole slew of damage, more particularly in later rounds. But that is going to be another video in the future. Or if you do want to talk about that now, please ask me questions about it in the comments below. I'd love to get that conversation started if you are thinking about it. So there we have it, a quick overview of how to value your startup, inclusive if you are pre-revenue. While there are a lot of big equations out there that can help you get close, it will really come down to the negotiations. And after all, the value of your company is purely what someone is willing to pay for it. I hope this video gave you something to think about, and if you found it insightful, you should check out my ebook. I'm going to put the link for you in the description below. It covers the first 10 things I would address when helping a company or an organization guide through or plan for a growth phase in their startup. Lastly, if you have any questions about what you've heard in this video, I would love to hear about it in the comments below. Thanks again for watching.